What happens when the United States, the world's most indebted superpower, demands that Japan, one of its closest allies, tank its own economy to protect America's? Well, Japan just said no. And now, after a $22 billion US bond auction collapsed, both economies are careening toward a dangerous standoff. This isn't a policy disagreement. It's a potential global financial rupture, with Japan moving to insulate itself from American volatility, and the US trying to hold on to its collapsing economic credibility. The pressure started quietly. Washington delivered a clear ultimatum to Tokyo: raise interest rates, strengthen the yen, and end your export advantage. Or the US would escalate tariffs and weaponize trade. But Tokyo pushed back. Japan's economy is already fragile. GDP is shrinking. And Toyota lost over $1.3 billion in just 2 months due to Trump's 24% auto tariffs. Now, the US is asking Japan to raise interest rates anyway, even though it risks detonating Japan's $9 trillion bond market. Why? Because the US needs Japan's currency to rise in value, making American goods cheaper abroad, and offsetting America's collapsing trade balance. But there's a deeper crisis here. America's latest $22 billion bond sale just failed. Foreign investors, including Japan, walked away. US participation dropped to 14%. Yields soared to 5.12%, the highest since 2011. Analysts are calling it a silent boycott by Japan's pension funds, who are shifting to euro-denominated infrastructure bonds for stability. The Wall Street Journal reports a 31% drop in non-US demand. That's not normal, and it's not sustainable. This isn't just a market glitch. It's a vote of no confidence in US fiscal leadership. So how did Japan respond? By flipping the script. Instead of folding, Tokyo is building a parallel economic strategy. Japan is expanding trade ties within the CPTPP bloc, partnering with Canada, Mexico, Vietnam, and even China and Taiwan. Toyota and Honda are ramping up production in Mexico and Thailand to bypass US tariffs completely. Mitsubishi is securing rare earths through Vietnam and Australia, vital to electronics, EVs, and defense tech. Tokyo's message is clear: we're not dependent on the US anymore. But Washington isn't backing off. Treasury Secretary Scott Bessent, Commerce Secretary Howard Lutnick, and US Trade Rep Jamieson Greer are now demanding that Japan allow the yen to appreciate by 20 to 25%. That's a massive currency shock, one that could destroy Japan's export economy. Japan's central bank, the BOJ, is already warning that consumer spending is falling, inflation is cost-push, not demand-driven, and any tightening would crush domestic growth. But Washington wants this done anyway, not for Japan's benefit, but to rebalance trade and keep US exports competitive. There's internal chaos in DC too. Bloomberg reports that US officials can't even agree among themselves. Japan suspended talks temporarily after American negotiators contradicted each other in back-to-back meetings. Japanese officials say they're being stonewalled, that the US keeps moving the goalposts. They're calling it performance diplomacy, meant more to satisfy Trump's base than to reach any meaningful deal. Meanwhile, those same negotiators are on their way to London to begin China trade talks. But if they can't hold it together with Japan, a key ally, how will they handle Beijing? Back home, America's economic picture is getting darker. Inflation expectations, measured by the spread between tips and nominal bonds, have spiked to 3.1%, far above the Fed's 2% target. Debt is ballooning. Trump's new stimulus plan adds $2.6 trillion to the federal deficit over the next decade. By 2033, the Congressional Budget Office says the U.S. debt-to-GDP ratio will hit 121%, and the current account deficit? Already at 3.8% of GDP, meaning the U.S. must rely on constant inflows of foreign capital just to keep the dollar from sliding. But what happens when those foreign buyers, especially Japan, stop showing up? This is what the Peterson Institute calls a dangerous economic paradox. The U.S. wants to reshore manufacturing, reduce reliance on foreign supply chains, and still attract foreign capital to fund its deficits. But you can't do both forever. If America pushes allies too far, the dollar loses credibility. And that's already happening. Japan's central bank is considering delaying tapering beyond Q4 2025 to avoid a bond crisis of its own. 10-year Japanese bond yields are at 1.26%, their highest since 2013, and Tokyo's economists are warning that tightening now would implode domestic demand. Privately, Japan is going even further. Tokyo is drafting contingency plans to admit Taiwan into the CPTPP, a direct challenge to both Beijing and Washington. If approved, it would shift the entire trade map of Asia, sidelining U.S. leadership in the region. Japan is no longer acting like a junior partner. It's moving independently, and with strategic precision. This is not rebellion, it's realignment. And if the U.S. keeps pressing, Japan might not just walk away, it might lead the construction of a new trade order entirely. So let's step back. The U.S. wants Japan to crash its economy, raise rates, and stop exporting, all to protect America's balance sheet. But Japan is resisting. It's redirecting trade, building new alliances, ditching U.S. debt, and preparing for a world without American financial leadership. This isn't just about bonds or currency. This is about credibility, and whether the world still believes that the U.S. can lead a stable global economy. Because if Japan steps out of line, and no one steps in to replace it, what happens to the dollar? What happens to trust? So we leave you with this. If Japan, one of America's most loyal financial partners, walks away, who replaces it? And what if no one can? The U.S. might still be the largest economy, but if it can't even keep Japan on board, what happens when the next bond auction fails? If you found this breakdown helpful, be sure to like, comment, and subscribe for more deep dives like this, and let us know below. Is the U.S. losing its grip on the global financial system? We'll see you in the next one.